So, welcome to FSMOne event where we help investors invest globally and profitably. My name is Harriet, client investment specialist from FSMOne, and I will be the MC for tonight. While the year is shaping up to be a down year with global growth affected by the high inflation reading and elevated interest rate, there's a reason to be more optimistic as market tend to rebound strongly following a large negative year. Our topic today is navigating the challenges, and we have with us today Mr. Robin. Mr. Robin has over 20 years of investment experience. He started out as a sell-side analyst and has experience managing both traditional long-only and alternative funds. Prior to Maybank, Mr. Robin was with Pengana Capital, the hedge fund arm of the National Australia Bank, where he was the executive director, core manager at the award-winning Pengana Asia Special Event Hedge Fund. He was also the lead equity portfolio manager at Asia Genesis Asset Management and senior portfolio manager at Pacific Mutual, a member of OCBC Groups. Mr. Robin was a British traveling scholar at the University of Nottingham, UK, where he graduated with a Master of Science in Economics. He is also a CFA chartered holder and also graduated with a Bachelor of Science in Accounting and Financial Analyst from the University of Warwick, UK. So now, without further ado, let us welcome Mr. Robin. Welcome.
Thanks, Harriet. Thanks for the introduction. I hope you can hear me. Harriet, can I be heard?
Yeah, I can hear you.
Okay, good.
Yeah.
Thanks for the introduction. I hope you guys have eaten dinner, and it's a very, very late start today. So I'll try to keep it short, and I'll try to keep it within half an hour, and then I'll open up for questions. I guess you can put your questions in the chat box later on, and I'll try to address as many questions as I can. But for this evening, what I wanted to do was to address what is the outlook for actually 2023, right? Because we are already finishing 2022. I just wanted to show you the challenges that are remaining. And as Harriet pointed out, there are some lights, some hope on the horizon. And what we are thinking is the storm clouds are actually plotting for a better 2023. Just let me share my slides for this moment. Yeah, that's right. So I'm sharing my screen. I hope everybody can see that. And as you can see, the title is Still Navigating Uncertainty, but Storm Clouds Are Parting, right? And obviously, as we can see, this year, as Harriet pointed out, it's been a very, very tough year for investors. So this is the year-to-date performance as of October 2022. And on the top part is equity markets. So you can see there's the developed markets, Asian markets, and ASEAN markets. And for Asian stock markets, you can see that almost every single equity stock market is down this year, right? And they're down between 15 to 30%, right? And of course, one of the worst hit has been China, down 40+%. And what we see is ASEAN actually has done reasonably well, right? Indonesia is one of the markets which is actually in positive territory, right? And India has also done reasonably well. But the rest of the markets, very, very tough year. Now, for fixed income, it's also been very, very challenging, right? So for your bond investments, every single market is down, right? So you can see whether it's the US markets, marked in red, whether it's global sukuk and Asia, it's marked in blue, it's also down. And it's been a really challenging year. And why is this so, right? Basically, the driver of this bad performance has been actually interest rates, right? So this year, the main driver of the tough markets have been interest rates. And why have interest rates been rising? Well, it's inflation, right? So in the US, what we have here is on the left-hand side, we can see inflation has been relatively high, 9%, right? And June, of course, it's come down, and more recently, it's 7.7% in October. Now, if you look at it, inflation in those days, maybe about 2 years ago before COVID, it was only between 2 to 3%, right? And things have shot up a lot. One of the reasons for the high inflation numbers, of course, has been the amount of fiscal spending by governments around the world, right? So the US, the UK, even in Malaysia, people have spent a lot of money to support the economies. And as a result, that has caused inflation around the world. But what we can see here is good news is inflation is actually coming down, right? So the higher interest rates have suppressed asset prices, both equity markets and bond markets. But the glimmer of hope here is that you can see inflation is actually trending downwards now, right? So you can see on the left-hand side, in October, it's 7.7%, down from the 9% before. And if you look at the breakdown in inflation, the good news is that most of the things is on a downtrend. So earlier on, energy, high oil prices was contributing inflation, the red part. But now, because oil prices are down 20 to 30% from the peak, it's no longer contributing to inflation. What has been contributing inflation in the US is shelter prices. In other words, home prices, right? What happened in the US is because of COVID, a lot of people moved out to the suburbs and they work from home. They rather be outside the city centers. And because of the amount of fiscal spending by the governments, they pushed up prices in the suburbs, right? And home prices have been going up. And as a result, shelter prices have been going up, and that has contributed to inflation. But what we are thinking is that actually inflation is no longer the issue. And we think that inflation is already peaking, right? And you can see from the CPI here, it's down from 9%. Even the core CPI, which removes food and energy, also is in a downtrend. Even shelter prices, we think it's going to be a downtrend in 2023. So we should not be so worried about inflation going forward. Why are we saying that property prices will come down in the US? Very, very simple. So what we have here in two lines. The top line is the property prices, right? And the bottom line, the blue line, is mortgage rates. So of course, as I mentioned, property prices in the US surged following COVID because of the huge fiscal spending. And that went into the pockets of the consumers in the US. And they went out to buy homes, right? And they wanted a bigger home instead of staying in the city, stay in the suburb. And that pushed up prices. But what we are seeing now is because mortgage rates have gone up so much, right? You can see, in 2021, it was 3%. Now it's surged to about 6% in the US. That would be a burden to future home buyers, right? The surge in mortgage rates, it's making homes unaffordable in the US. And what we think is whenever, interest rates surge like this, we can see property prices decline after that, right? So what we think is in 2022, property prices have already peaked and it's on the downtrend because mortgage rates have surged up. Of course, with property prices peaking, what we are thinking is shelter prices will also peak, and then inflation would not be a problem going forward. Now, if you look at inflation around the world, it's high in the Western world, right? But what about Asia, right? So if you look at Indonesia inflation and India inflation, so in Indonesia, on the left-hand side, it's gone up to 6%. Although it's high, it's not as high as the US. And if you look at Indonesia, actually, this inflation compared to history is not very, very high. Similar for India. Although it's almost 8%, it's not high relative to history. And actually, what you see is Indonesia, India, people are quite used to high inflation. And that's why the economies in both these countries have held up even with the high inflation, right? So it's not a problem. And that's why stock markets in Indonesia and India are still doing quite well and quite resilient. Not so, of course, in the US and even in the other stock markets around the world, right? So what we have here is interest rates on the left-hand side. And on the left-hand side, what we have is breakdown by various countries. And if you look at it, the dots are what interest rates were at the start of the year. The red dot is what it is currently. And what are the boxes? The boxes are the range of interest rates prior to COVID. So when you look at this chart, the red dots are very, very high, right? and they are higher than what it was pre-COVID. So for the US, it's 4%, much higher from the range of 2 to 3% before COVID. So interest rates now are very, very high in the US and similar around the world, except for China, right? So you can see China, actually, the rates have not moved since the start of the year, and actually it's below pre-COVID levels. So really, China is loosening while the rest of the world is tightening, right? And why is this so? Because US inflation has been surging and they need to push up interest rates to curb inflation, and that has affected financial markets. So when you look on the right chart here, we have two lines, and the lines are the short-term interest rates and the 10-year interest rates. Of course, both have surged up. And of course, with the surge interest rates in the US, as I mentioned, it's pushed down financial markets. But what I wanted to highlight is what we see here is an inversion of the curve, right? In other words, the short-term interest rates, the blue line, is now higher than long-term interest rates, right? The Fed fund rate is higher than the 10-year rate. Now, this is not a good sign. Usually, it tells you that we are heading towards a US recession, because what we saw is, we saw this similarly before the COVID period. We saw this in the global financial crisis, right? So the blue line, the short-term rates, was higher than the orange line, right? Usually it's the other way around. The short-term rates are lower than the orange rates, right? Now, what we are saying is that the US in 2023 may head into a recession, and that's the challenge we face in 2023, right? So we are still navigating tough periods. So it's not smooth sailing from now on. If you look at the US economy on the left-hand side, we see the US manufacturing, right? So it is still growing, the US manufacturing, but the blue line now, it's at 50, which is between growing and shrinking. And this is the tipping point, right? Because whenever manufacturing dips below 50, it usually foretells a recession. So we saw that before the global financial crisis in 2008, and we also saw this in the COVID period. So what we are saying is that the US economy is slowing, and there's a high chance of it going to a recession in 2023, but it's not in recession yet. And what is holding up the US economy is so far jobs. So on the right-hand side, what we are seeing is the US jobs growth. It's still between 2 to 300,000, right? And the critical point when it drops below zero, then in other words, there's no more job creation. So we are looking at that, and when that happens, I think it can be confirmed that the US will be in recession. But so far, it's growing slowly, but it's not in a recession. But what we are thinking is, in 2023, probably in the first quarter, the US will tip into a recession. Now, it's not just the US. If you look at the rest of the world, right? So what we have here is the global PMI, the red line here. This is a measure of global manufacturing activities. And if it's above 50, it's growing. Below 50, it's shrinking. And what we are seeing is also it's already in the tipping point. What is important also is the blue line, the number of countries which are growing. So now most countries are shrinking compared to growing. And where has been the hardest hit has been in Europe, right? Marked here in this square here. Most countries are shrinking in Europe, and it's below 50. The reason being is that in Europe, they are facing high energy prices, rising inflation, and a weakening economy. So that's not good for the EU. And as a result, the global growth around the world is slowing. Now, if you look at these two charts here, talks about US recession, right? And I guess the bad news is based on our indicators, our own internal indicator, our own model, what we are seeing is there's a high risk of a recession heading towards 2023, and that's about a 70% chance of a recession heading into 2023, right? So our internal model actually predicted COVID-19 and also went up in the GFC. So I think it's a pretty good model to use. If you don't believe in our own model, we also have the New York Fed model. Is used by the Federal Reserve of the New York. And what we are seeing also is recession risks have increased to about 30 to 40%. So there's probably a high chance of a US recession in 2023. So what happens in a US recession, right? So if you look at the stock market, stock markets will fall in the US by about 30% from peak to trough. And usually, once the recession starts, the market will only bottom 8 months in a recession, right? So it's not so good news for stock markets if there's a US recession. What about for bonds, right? For a fixed income market. So what we have here in this table is the Fed funds rate and then the US 10-year, the long end rates. The Fed funds rates are the short-term rates and the US 10 years, the long end rates. So what you find in US recession is, generally speaking, interest rates fall, right? So in other words, actually it's pretty good for bonds, right? So what you should be positioned for in a US recession is you should be long sovereign bonds, because when US goes into a recession, the Federal Reserve will be forced to cut rates, and rates overall, both short-term and long-term, will be cut and go down, and government bonds will benefit in the recession. So really, to sum up, government bonds will benefit, but corporate bonds, because spreads will widen, may not be so positive, and equities will fall in the recession. So if you look at the US market, it's only down 15-20%. So there's more downside in the US markets, right? But what I also wanted to talk about is geopolitics, right? So we need to differentiate within US markets as well as Asian markets. And in the past, we have a world dominated by the US, right? So after the World War II, the US was the dominant world power. They had army bases around the world. And actually, what you have is in 1980, most trade was conducted with the US, right? So that's marked in blue. Most countries' top trading partner was the US, right? Come 2018, on the right-hand side, bottom right, marked in red, most countries' biggest trading partner is now China. China's trade now dominates the world. So for instance, Malaysia's top trading partner is China. So we trade a lot in exports and imports. We export a lot of palm oil and electronics goods to China. China also sends a lot of exports to Malaysia. And now China is a very, very large economy, right? So we are moving from a US-dominated world to a multipolar world, in a world where no one country dominates. So what we are saying is, in future there will be desynchronization, deglobalization, right? So in the past, everybody was synchronized with the US. When US markets went up, we all went up. When US markets went down, we will follow the US. But now what we are saying is there may be a little bit of desynchronization, right? And what we are saying is that actually Asia will decouple from the US. So you look at the left-hand side, what we have is the Asia index, MSCI Asia ex-Japan, and the S&P, which is the US stock index. So you can see that actually Asia peaked last year, February, and it's been a long downtrend now. The S&P only peaked in 2022 at the beginning. Now you look at China, a similar story. In fact, it's down even more compared to Asia, and it peaked somewhere early last year. So what we are saying is, because Asian stock markets are really down so much, it should lead the recovery, right? And we are thinking that heading into 2023, Asian markets will lead the recovery, and there's more downside in US equities. So if you think about it, Asian markets are down so much already, 30-40%. China markets are down even more from the peak, 50%. There's more upside than downside for these markets. Whereas for the US, because of US recession risk, there is still more downside for the US. Yeah. Now, recently, we are a little bit more confident now we are reaching the bottom. Why? Because of this chart as well. This is the Asian dollar index. in orange and the Asian stock index in dark. So what you notice is Asian currencies around the world have depreciated against the US dollar, right? And you can see ringgit have gone from 4 to now 4.7. This is mirrored across Asian currencies, right? Whether it's Taiwan dollar, Korean dollar, even Singapore dollar, right? So Singapore dollar has also moved from 130 now to 150, right? But what we've seen recently is this Asian dollar index, when it goes down, it means it's depreciating. But what we notice is recently it's bottomed. And there's been a little bit of a bounce in Asian currency. So even ringgit has appreciated versus the US dollar recently. And whenever the Asian dollar index bottoms, the stock market, Asian stock market also bottoms. So what we find here recently is done that. We also saw that in the COVID period. We also saw that in the global financial crisis and the Asian financial crisis in 1998. So the bottoming in Asian currencies suggests that Asian stock markets have also bottomed. So that makes us a little bit more confident. The other glimmer of hope is also on China, right? We need to talk about China now. So throughout the year, China has done a lot of easing, right? And what we measure easing by is by this blue line, the total social finance. This total social finance is a measure of credit in China. So whenever things go up, in other words, they are boosting liquidity into the economy, and usually stock markets will rise. So we've seen that before in 2018. We saw that also in 2015. But in 2022, it has not worked. Total social finance has gone up, but stock markets have not recovered, especially in China. On the right-hand side, we also see a similar story. The total social finance is the blue line. And usually when it bottoms, property prices in China will also bottom. But this time around, property prices have not bottomed, even though total social finance has gone up. Now, why is this so? Why is the stock markets in China done so badly? And why are property prices also doing poorly in China? Of course, it's been the COVID lockdowns, right? So we need to pay attention on China in Asia, because now China is the biggest economy in Asia. And it's also the second biggest economy in the world now. It's 20% of world GDP. So what we saw is we have a sharp lockdown. And when COVID started in 2020, right, there was a massive lockdown in China. And after that, they managed to control COVID and things rebounded pretty strongly. So that's the manufacturing activity in China, and that bounced up. And actually 2020, 2021, China was doing quite well. Then recently, we had the Omicron virus, harder to control. So China had to lock down many, many times, and that's affected the economy in China. It's been up and down, and it's barely growing, right? It's above 50 and then below 50, above 50 and below 50. Now, the question is, why does China want to continue on its zero COVID policy? Now, that's explained by the right chart, the percentage of people that have received boosters, right? So if you look at it, in China, only about 50% of people have received boosters, right? That's a low amount. Hong Kong, more than 70%, of course, Singapore, 80%, right? Malaysia also is about 50%. Because China is a large country, they don't want to open up their economy because a lot of people will get COVID and die if they don't have enough boosters. So you know in China, they're using Sinovac, and only if you have 3 doses will it be effective against COVID. 2 doses is not enough. And what they found is for the elderly, a lot of the elderly are not protected. They don't have the full 3 doses. And they've done a calculation that if they open up the economy without boosting everyone, then there would be 20 million people who may die because of COVID, right? So they are very cautious on the opening, and that's why there's been a concern on that. But actually in November, there's been some pretty good news on COVID, right? So what they've announced is a 20-point plan on COVID, right? They didn't say that they are going out from COVID, but at least they have a plan to open up gradually, right? So they reduced central quarantine, 5 days in central quarantine plus 3 days at home from 7 plus 3. They are also encouraging more and more people to take boosters, right? And then I think they are opening up gradually and following the Hong Kong model. So when the Hong Kong boosters went up to past 70%, they open up the economy, right? And same thing for Singapore. So they are actually trying to move the amount of percentage of people with boosters up to 70%, and then they will open up. So that's good news for China. And that's why you can see recently the Chinese market has been pretty strong in November. The other positive thing in China and Asia is the property sector. So just recently, they announced a comprehensive plan to stabilize the property sector. So a year ago, they wanted to push down property prices because it surged up too much. And what happened was, the property sector in China has tanked, right? So there's very, very little confidence in Chinese property companies, and the major big one which hit the headlines was Evergrande, right? So that company is going to go bankrupt, and that has created a lot of concerns in the property sector. But recently, they've announced a comprehensive plan to help the property sector, including property companies. So they have allowed debt deferments. They've trust companies and banks are instructed to help the property companies, to support the property companies so that they do not go bankrupt. So when they do this, there will be more confidence in the property sector. And because the property sector is still about 15% of the economy, at least there's some stabilization. So what they want to do is stabilize the property sector, and then over time, open up the economy. And with a stronger economy, people have more confidence to buy property. And that has resulted in, stock prices actually going up very, very strongly over the past 2 weeks recently. Now, if you look at valuations, when you look at stock valuations, you can see Asia and China are very, very cheap versus history. The US is not so cheap because it hasn't fallen so much. So really what we are saying is that if you look globally, the cheapest markets are in Asia. And that's where we should focus in the rebound in 2023. And if you can look at this chart here on the top is the PE and the index. Whenever the Asian PE falls to these levels, it usually signals the bottom. And that's why we are confident that in 2023, there would be a rebound. Now, this is for the stock market. And what we are also seeing is the drawdowns, right? So on the left-hand side is Asian equity markets. As of end October, Asian markets are already down 45% from the peak. And that's really crisis levels already, right? It's as bad as the TMT bubble, almost as bad as the Asian financial crisis. And 45% is really a crisis levels. But actually, you look at Asia, although there are difficulties, no country is in a recession. Now, on the right-hand side is US equity markets. The S&P at the end of October only fell about 20%. It's far off from the usual range of 30%, right? So we think there's more downside in US compared to equities, and the rebound will be led by Asian equity markets. Now, what about bonds? What we have here are the yields of investment-grade bonds in Asia, US, and EU. Of course, what we are seeing is that yields are also very, very attractive now. You're getting about 5 to 6% investment-grade yields, where just 2-3 years ago, it was very, very low, right? 2 to 3%. So there's a lot of value in the bond markets. And I think even in 2023, the bond markets should be positive, right? And because inflation and 10-year rates appear to have peaked with declining interest rates, that should be a booster to the bond market. So this is the last slide I have before the summary. And if you look at it, on the left-hand side is the yearly performance for Asian equities. And the right-hand side is a table on fixed income for Asia. What you notice is every crisis year is followed by a strong positive year. So for instance, in the global financial crisis in 2008, stock markets fell by more than 50%. The following year, it surged by 68%. Now, this year, it's also been bad. As of August, it was down 20%. Actually, as of October, it's down even more. I think in 2023, it should be a positive performance for Asian equities. Same thing for fixed income. It's been a tough year so far, down 10 to 15%, and we think Asian bonds should rebound, right? So whether you want to choose fixed income or equities also depends on your risk appetite. Of course, it's going to be more volatile for equities. If you are more risk averse, then I think you should look into fixed income. Although the returns may be lower, it's less volatile, and you still get positive returns. But if your risk appetite is high, then the greatest gains will be probably found in Asian equities. Yeah. So to sum up, this year has been really tough. Rising interest rates have depressed the market, and we are still navigating uncertainty because US recession risk is high. But there are reasons to be positive, and storm clouds are parting, and we think 2023 will be much better. One reason is inflation has peaked, right? And rates have likely to have peaked. And as a result, that will be good for both fixed income and equities. Sovereign bonds is where we're looking at for the moment, right? And if you look at equities, because Asian markets have really down so much, we think that the downside is much more limited, right? US stock markets may still be challenging because I don't think it reflects the US recession risk so far. So really, it's going to be a more positive year in 2023. And I think I'll stop here for the moment and address all the questions you have.
Okay, thank you, Mr. Robin, for your very insightful presentation. We will start our Q&A session now. So the first question, what will affect the Malaysia fund or equity market?
Okay. So of course, top of people's minds now is the elections, right? So in the short term, I think the elections will play a part in Malaysian market, right? So I think people's concern, I think I'll address the two questions there as well. There's also one saying, if no single party wins a majority of the votes. So I'll just address those two. So our thinking is, yes, if no party gets a strong majority, then, the stock market also won't do well in Malaysia. The reason being is that we need a stable government, we need stable policies, and we need a party which can work together and have good economic policies, right? So in the very, very short term, that will be the driver of Malaysian equities, right? Now, if a party manages to get a strong majority and has very, very good economic policy, I think Malaysian stock markets will do well, right? Because over the past 2-3 years already, we've been quite a depressed stock market in Malaysia, right? Of course, Malaysia is not immune to the world, right? What happens in the US will also affect Malaysia as well. So as the US falls into a recession, it also will affect Malaysia. But if there's a strong majority and if there's good economic policy, then Malaysia may do better even in 2023 and could follow the Chinese markets.
Okay, do you think US market has seen its bottom? If not, what do you think so?
Yeah, I think I've addressed this in my slides already. And what we are saying is that we don't think it's bottom, the US markets, because it's only fallen 15-20%. And because in 2023, we think the US will dip into a recession. And because when the US dips into a recession, corporate earnings will have to be cut. And that would drive stock markets down. And on average, stock markets in the US recession dip as much as 30-odd%, right? So there's a little bit more downside in the US markets.
Okay, so which segment of Asia fixed market offer better risk reward profile?
Right. So Asian fixed income, we've seen a very, very tough market this year. And what we are seeing is that I would say that what we are seeing is Asian investment grade bonds. some of them are coming up with 7 to 8% yield, right? And they're trading like high yield bonds, right? And some of the regions where we like is even some of this Chinese investment grade bonds, Korean investment grade bonds. They are actually yielding very, very high rates now because everybody is sold off on Asian fixed income. So we would want to focus on that. We don't need to go to the very, very risky high yield bonds. Even some of the investment grade bonds, you can find very, very good yields.
Okay, so as US could enter into recession into 2023, should we really hope for good return next year? Are Asian stock and fixed income return correlated to US economy?
Yeah, I mean, if you look at it, generally speaking, Asian stocks are correlated to the US, right? But what we are seeing now is because of the globalization, there should be a decoupling. So what we are seeing now in China is that the Chinese government is trying to boost their economy, right? The US is trying to slow their economy by increasing interest rates. Because of the difference in the economic cycle, right? With China boosting its economy, we think in 2023, Asian stock markets should do better than US stock markets, right? Because China, as they open up, their economic growth will do better, and that should help corporate earnings in 2023. And because also, the Chinese stock market has also fallen so much this year, we think 2023 should be better for Asia. So although it be volatile, right, we think that the bright spot remains Asian stocks. Similar for fixed income, same story. I mean, Asian fixed income also has been hit badly, right? And because there's been a lot of stimulus in China now, that should help Chinese bonds and stocks, but that should also spill over to the rest of Asia because, as I pointed out, ASEAN countries, India, biggest trading partner is China, right? If the Chinese economy recovers from this COVID period, that should foster economic growth in the rest of Asia too. So we are thinking that because we've already down so much this year in Asia, 2023 should be better for Asia. And even with US going to a recession, we think Asia could decouple from the US.
Okay, the next question, do you see risk in particular sector, let's say technology or real estate sector?
Right. So maybe I'm not sure whether you refer to global tech or maybe Chinese. Maybe I'll talk about China because maybe it's concerns about Chinese tech and real estate, right? So there are risks, of course, in China, tech and real estate on policy risk, right? So, of course, in 2021, they cracked down on real estate because, property prices in China has actually gone up so much. And the gearing in that sector, a lot of property companies overgeared themselves, companies like Evergrande, right? So for tech also, some of these Chinese tech companies, the internet companies, they also did a lot of, I would say, not very competitive things, right? They basically were a monopoly, right? Let's say you're on the Taobao platform, you cannot sell on the other platforms, right? So if you're on Taobao, you cannot sell on JD. So they cracked down saying that you cannot do that. That's a monopoly. If you want to sell in Taobao, it's fine, but you also have to allow your vendors to sell in other platforms too, right? So these are the examples where they crack down on this, and as a result, stock prices of both Chinese tech and property companies went down a lot. But of course, in the past year, there have been no new legislation or policies to suppress tech sector. And in fact, for the property sector, they are trying to revive it now because they think that, the correction's enough. They've already weeded out all the weak property companies. They only want the strong and responsible companies to be participating in the property market, right? For instance, if you look at it, Evergrande, they were not so well run. They invested in a lot of things outside the property sector, right? They went into electric vehicles. They even bought a football club. and that resulted in gearing very, very high, and that caused a systemic risk for the Chinese property sector. And what they did was they are weeding out all these weak players so that the property sector can be more stable in the future.
Okay, we still got a lot of questions coming in. Okay, do you think the US recession is a short or shallow one or more severe one? Severe.
Right.
Yeah.
I mean, it's good that I ended my presentation in 30 minutes because I see so many questions. I guess it's been such a tough year. Everybody has a lot of concerns and questions, right? But it's good. Now, US recession is a short, shallow one or more severe one. I think it's hard to tell at this point, right? We shall need to see the data as it pans out, right? So if it's a normal recession, as I mentioned, it's going to be 30% down. Hopefully, it doesn't turn into another global financial crisis. Then US markets will go down 50%, right? So what we need to see is when it goes into a recession and the US does cut rates. And when it cuts rates, maybe the economy will bottom and then there'll be a short recession. However, we are not sure that will happen. What happens if they cut rates and the economy doesn't revive, right? Then it's going to be longer. But at this point in time, it's hard to tell, really. I don't have the crystal ball in that. But what I can say is that US in 2023 likely to fall into recession.
Okay, so what will be the likely path of the inflection be if the US Fed show reluctant in pivoting from their tightening course?
Okay, this is about inflation. So the likely path of inflation, of course, what we are actually saying in our message is that we think actually inflation's on the downtrend already, right? And it's gone down from 9 to about 7.7%, right? And the worry is that inflation continues going up, right? But what we are saying is not to worry, right? Because if you look at it, US has already increased interest rates a lot, and that is going to bring down inflation in 2023. There's a bit of a lag, right? Things don't work immediately. So when they increase interest rates work with a lag, and that would be seen in 2023. Because when you increase interest rates, cost of borrowing go up, right? Mortgage, people don't want to buy houses because it's too expensive, right? And that would result in lower property prices in 2023, and that would lead to lower inflation in 2023. Now, I'm not sure whether I answered this question, but from my point of view, will inflation be high, always being at very, very high rates, at 6-7%? We don't think so, right? Maybe it will be higher than before. It used to be just 2%, maybe it'll be 3%. Reason being is because of the globalization. Everybody wants to set up their own tech plants. Everybody wants to set up their own supply chain, and that would increase costs. Then, of course, high oil prices also may increase costs a little bit, right? And, sustainable ESG and all that may increase costs because people are not investing in oil and gas. So that may increase costs, but we don't think it's going to be 6 and 7% going forward, right? Why? Very, very simple reason. High periods of inflation were only seen during periods of very, very high growth and growing population, right? We saw that in the 70s, right? Population growth in the US was strong. Population growth in China at that time was also very, very strong. But now you look at demography, China has a problem. Actually, shrinking population. Japan's even worse. Even the US now, the population is not going up. So I don't think we are going to see high inflation in the long term. Okay. Next one is this Chinese property sector. The worst is over. Is it worth buying Chinese property stocks or bonds? Yeah, we think the worst is over for the Chinese property sector. Yeah, and I would say, is it worth buying? At this point, I would say we should look into it. But some of these names have gone up a lot in the past 2 weeks. But we should look into it. And whether you buy stocks or bonds, it depends on your risk appetite. Because although some of these probably stocks can go up a lot, they are very volatile as well. They can come down a lot as well. Bonds will be probably more stable, right? But you also need to choose the right names.
Okay. Would Evergrande default render investor avoid China fixed
Oh
income?
yeah. So actually, the default in Evergrande is already made all investors avoid Chinese property bonds for a long time, right? So I think for the past year already, we've seen Chinese fixed income, Chinese bonds correct a lot, right? Even some of the better names. So I guess you need to be selective here, right? Yes, if you look at Chinese bonds, you have the Chinese property bonds, right? They are yielding very, very high rates. Of course, there's no guarantee you can make your money because they also may default, right? Going down the line. But what we are saying is that there is some Chinese bonds, which is actually nothing to do with the property sector, right? Chinese internet sector, they also have bonds. Chinese energy, also they have bonds. And they are actually yielding pretty good rates. So maybe, you shouldn't just say don't invest at all in Chinese income. It's just got to be a little bit more selective.
Okay. Do you have a view on Asian currency against USD? Will the recent appreciation against USD sustain
Yeah.
into 2033?
Yeah, I think that's our view. We've seen a very, very strong US dollar for a long period, more than a year plus. Now, what we are saying is that once interest rates peak and come down, there's less reason for people to plow into USD, right? The reason people are going to USD is because, higher interest rates, investors want to go to USD, and that's moved investors from Asian currencies to the USD because actually Asian rates haven't gone up as much, right, as the US rates. For instance, you look at Malaysia rates, although it's gone up from 3, it's only gone up from 3 to 4+%, whereas the US has gone up from very, very low rates, 0.25% to 4%, right? The magnitude of the increase been more than 300 basis points, and that has resulted in everybody going to the US dollar. Now, with inflation and interest rates peaking, we think there's less reason for investors to go into the USD, and we think that Asian currency should do better against the US dollar.
Okay. Just now you mentioned that the US most probably go into a recession in 2023. So in the past, most of the country will follow US into recession. Since now, China is the biggest economy impact to the global. Does that mean that we may not see China recession, although US go into recession?
Yeah, I mean, in the past, you're right. Whenever US goes into recession, everybody's dragged down, right? We saw that in the global financial crisis, right? And you are right. What we are saying now is that because the world has changed a little bit from previously, China is also bigger than what it was before, right? In 2008, at the start of the global financial crisis, China was only about 10% of the world economy. Now it's about 20%, right? So what we are saying is that because China is trying to boost its economy now, we think that although you may see a slowdown from the US recession, the fact that they're trying to boost the economy means that they would probably stay out of a recession, even though US goes into one.
Okay, considering there's a time lag between inflation and rates, any possible scenario of deflation if US Fed does not bring the rates down quickly enough?
Let me see. Deflation. Not sure whether I understand this question. Time lag. Okay, now there is a time lag, right? Let me just see whether I can answer this because I don't quite understand the question. But let me see. So yes, there is a time lag between inflation and rates. So what we are saying is that US Fed actually they were slow to increase rates, right? They only started this year when they should have started last year. And as a result, inflation just went up. And I think there's probably a 6 to 12 month lag. And with rates going up now, we should see inflation coming down next year.
Okay. So what is the current market view on the outcome of Malaysia election?
Well, I mean, I think our Malaysia team has three scenarios, right? Or maybe two main scenarios. One is if one of the parties has a strong majority and able to implement good economic policy, then I think it's pretty good for Malaysian stock market, right? And over the past 4 years now, what we've seen is very unstable governments and bad economic policy, right? So, when you have a change in government every couple of months, right? We have seen already 3 PMs, right, over the past 4 years. That's not good for stability. And, obviously foreign investors won't want to come in if there's no stability, right? So we need stability, right? And we need good economic policy, right? Then we see that, then we should see a better stock market because, over the past 4 years, stock market actually in Malaysia has been pretty poor. Now, if you look at not just Malaysia, if you look at the UK, right, the same thing. They've also seen, I don't know, maybe 4 PMs now in the past 5 years, and you've seen the UK economy stagnate, right? Even a developed economy like the UK, right? So I think foreign investors would like to see stable government, clear policies, right? And if we get that, then we will see a good stock market. If it's going to be a hung parliament, let's say, now there are many parties, competing. So if everybody gets, I don't know, maybe 25% each or 30% each, then it'll be very, very difficult to move forward, right? And if you just get 30% each, you will need to make a coalition. But usually coalitions, not so good because they maybe have different agenda. They may have a different, I would say, direction, right? And it's very, very hard to I would say, manage. I think we've seen that before as well, right? I think we've seen that experience before. So I think what we need is strong majority and good economic policy.
Okay, the next question. Next few years there will be many China USD bond going to expire. So would they able to raise a new bond to redeem their expiring debt?
Yes. So I think this is what's happened recently in November, right? So, and what has happened in the Chinese property sector, maybe I'll just talk about Chinese property sector. A lot of the Chinese property companies, they were unable to refinance, right? They had borrowings, the bonds, they are unable to refinance because property sales have been poor in China, right? And as a result, they couldn't refinance and they had to default, right? So for property companies, it was a great problem. But recently, as I mentioned, they are allowing a lot of these companies to defer the repayment on their debt, right? And do some restructuring. And that would help the Chinese property companies, right? What they are also doing is they are allowing some of the policy banks, right, to come in to finish the projects, right? And that will also help some of the Chinese property companies, right? So that's good for some of the stronger property companies. And what they are also saying is that they want the stronger companies to take over the weaker ones, right? And that would help the overall market. Now, this is for the Chinese property companies. There are other companies which are actually not really that affected, right? So some of the Chinese internet companies, some of the Chinese energy companies, they also have bonds. I don't think it's a problem for them to raise new bonds because actually they are actually generating a lot of cash flow. It's just that now because of high interest rates, they will have to refinance at a higher rate now, right? That's all.
Okay, for fixed income, should we buy long-term, long duration fund since you expect the interest rate to fall?
Oh, actually, it's a very good question.
Mm.
I think it's a very, very tough question to answer, right? Because yes, longer duration bonds are more sensitive, right, to changes in interest rates. So when rates fall, then longer duration should benefit. But then what we see is that the short-term rates will fall more than the long-term rates. The long-term rates will only fall slightly, whereas the short-term rates will fall faster, right? So you need to see across the curve where you want to buy to get the maximum impact. And I would think that maybe you want to go, maybe not so long duration, maybe you want to go to the 5-year range, because then you would benefit from the fall, plus you have a little bit more sensitivity to interest rates. Whereas if you take too long, it just falls a little bit, right? So you do not benefit from the cut in interest rates, maybe in 2023. Yeah, but I know this is a very, very technical question. Yeah.
What will be the path of revision in earning from now here on? Has the market priced in any impact on earning?
Okay, so what we've seen is for Asia, actually, people are very, very bearish already. People have cut earnings around Asian stocks, right? So not just Chinese. So Taiwan companies, the tech earnings have been cut. Korean companies, a lot of the tech and industrial companies have been cut. Even Malaysia got earnings have been cut already, right? And I would say that at least for China, Taiwan, and Korea, they are probably already reflecting a sharp slowdown in earnings in 2023. And that's why, stock prices are already corrected as a result. Now, for the US, it's a little bit different, right? What you notice is the earnings have not been cut a lot, right? In fact, a lot of analysts, if you look at the expectations, they think 2023 will be stable earnings compared to 2022. So as a result, we think it hasn't reflected the recessionary impact, right? Because if there's a US recession, earnings will have to fall at least 15%, right, from 2022. So it's not reflected for the US.
Okay, so we have our last question. But this is depends on Mr. Robin, your decisions. Can you please recommend a few funds for investors?
Well, of course, I come from Maybank now. Of course, I recommend Maybank funds, but no, I don't want to be specific here. So what I want to say is, you're right. There are a lot of funds, but of course, I would encourage you to talk to your financial advisor to check out on your risk appetite, right? But generally speaking, I would say 2023 should be better. Now, if your risk appetite is low, then I would say, even fixed income funds should be all right. Your risk appetite is higher, then equity fund, especially Asian equity fund, should be better because, as I mentioned, the few factors has already come down so much. It's already reflecting the recession risk, and of course, China has recently started to to boost the market, right? So that is what I will leave you with. Maybe you can talk to your financial advisor, whoever it is in the FSMOne, right? And what I would say will be a better year next year, but my tilt will be towards Asian funds. If you can take the risk, then Asian equity funds will be a little bit better. Although it could be volatile because as everybody here knows, everybody's quite worried about also the US recession risk, right? So although it may go up, it may go down, go up, go up, go down and up a lot, it may still be a volatile market heading into first quarter 2023. Yeah.
Okay, I think the time is up. So if you have any further question, feel free to send us an email at clienthelp.my at fundsupermart.com. So replay of tonight's session will be available right after this. So head over to our YouTube page at FSMOne Malaysia to catch this replay. So once again, thank you very much, Mr. Robin, for joining us today. Yeah, and
Thank you, everyone. Thanks for participating and taking your time this evening to listen to the outlook. Hopefully, you gain a few insights, and hopefully, it's a better year in 2023. And thank you for joining the call. Goodbye.
Yes, thank you, everyone. Good night.